A very good morning to all the participants of this webinar from DTRTI Lucknow. I'm Arvind Mishra, welcoming you to the DTRTI Lucknow webinar 2021 series, under which we are doing methods of depreciation, depreciation accounting, part 2. So friends, as we have discussed earlier, broadly three methods are used to account for depreciation in the books of accounts, and those are straight line method, diminishing balance method, and the units of production method. In the straight line method, there is a constant depreciation charge every year for the entire useful life of the asset if the residual value does not change. In the diminishing balance method, decreasing charge of depreciation is used for every year, for every subsequent year, over the entire useful life of the asset. And in the units of production method, there is a charge which is based on, the depreciation is based on the expected use or the expected output in terms of the units produced. We all know that the income tax rules prescribe the diminishing balance method, except in the case of those assets of an undertaking which is engaged in the generation and distribution of power. Now, we start with the first method, which is called the straight line method. In the straight line method, an equal amount is used as a depreciation for every year, and so we say that an equal amount is written off every year during the working life of an asset, so that the cost of the asset is reduced to nil, or we can say the residual value comes to nil, or the residual value is taken to be nil in this method. And every year, therefore, the cost is reduced by a certain amount, which is used as depreciation. The advantage of this method is that it is very simple method to apply. No difficult calculations. Once we have got the amount of depreciation, the same amount would be used every time. And this gives us accurate results, especially in cases of leases. So particularly in leases, we use this, and in case of plant and machinery also. This method is also known as the fixed installment method, because every year a fixed amount is reduced as depreciation from the cost of the asset, or from the initial cost of the asset. Now, according to this method, the cost of the asset will be reduced to nil ultimately. Now, therefore, the formula is the straight line depreciation is equal to the cost of the asset, or the cost of acquisition of the asset, and from that we reduce the scrap value in case, because we are estimating a scrap value that at the end of the useful life, the asset would have some scrap value for which it could be sold. So we reduce the scrap value and from the cost of the asset. For example, the cost for which we have purchased the asset is 100 rupees, and we are estimating that at the end of 5 years, which is the useful life of that asset, the scrap value would be 10 rupees. It is an estimate. So we reduce 10 from 100, which comes to 90, and we divide 90 by 5, which is the useful life. And we are then getting a figure of 18. So what we'll do is that 18 rupees we will use as depreciation, and we'll debit the profit and loss account with 18 rupees every year. So that is what is called the depreciation amount, how to calculate the depreciation amount. In case we want to get the depreciation rate, we divide this depreciation amount by the cost for which we have purchased or acquired and multiply the fraction by 100. The underlying assumption here is that any particular tangible asset which is there, it will generate equal utility during its lifetime every year. What I mean to say is that the wear and tear or the utilization of their asset will happen by equal parts every year during the entire life of the asset. That is the underlying assumption here. But in all cases, it cannot be true. This assumption may not be true because what is happening is that in the initial years, whenever we buy a new machine or something, the expenditure which is incurred on repair and maintenance in the initial years is low, whereas in the later years, the maintenance and repair expenditure will be high because the asset becomes older, and as the asset becomes older, it needs to be maintained more properly, and more expenditure is required to be incurred on its maintenance. So therefore, we cannot say that this asset is generating equal utility during its lifetime. And apart from this, the asset may also have varying capacities over the years because its capacity to produce products may reduce, its efficiency may reduce over the years. So therefore, as its capacity goes on reducing and as the expenditure incurred on the repairs keeps on going up, and a logic is indicated that depreciation every year is unequal and not equal. However, we know that there are many assets who do not have much repair and maintenance expenditure. In that case, the expenditure on repair and maintenance is insignificant. And therefore, wherever repair and maintenance expenditure is insignificant, a straight line method could be more useful in such a case. So, if we were to think about in what cases we should be using straight line depreciation method, so we should be using it where insignificant repair and maintenance expenditure happens, thereby indicating an opportunity for equal utility of the asset in every year in the entire lifetime of that asset. When we use this method, the period of use of an asset in a particular year has also to be considered. For example, in the year of purchase, it is possible that the asset may have been available for use only for part of the year because it was purchased not in the initial part of the year, maybe it was purchased later during the course of the year. And therefore, the depreciation would accordingly be proportioned to reflect the period for which it was available for use. And when we say available for use, why do we use the word available for use? Because it is properly installed, commissioned, available for use, even if it is not used. But it is available for use. It will incur some depreciation because any item which is not even used also depreciates. Of course, that item which is used regularly or irregularly, whichever way, that will also be depreciated over a period of time. That is why the word available for use is being used rather than just used. For example, an asset was purchased on March 1, 2017, and the enterprise prepares the financial statements for the year ending March 31, 2017. So the asset was purchased only 1 month before the end of the financial year. So depreciation will be provided for a period of 1 month only. Please remember that we are talking about accounts here, not about taxation. When we talk of taxation, it is the tax law which will decide that for the usage of any asset for any number of months, how much depreciation will be provided. And there it has been provided in the Income Tax Act that if the usage is for more than 6 months, then if the actual usage is for more than 6 months, then we provide the full depreciation, otherwise we provide a half depreciation. But for accounting purpose, if the asset is used for 1 month, the depreciation of only 1 month would be provided. Similar situation will arise in a year in which the asset is retired from its intended use or is sold. When it is purchased, it is the same thing. The depreciation will be provided for the period for which it was available for use. Similarly, for the year in which the asset is retired or where the asset is sold, in that case also, depending upon the date of its selling and the date of the retirement of the asset from intended use, the proportionate depreciation would be provided depending upon for how much time that asset was available for use to the business. Now the next one is reducing or the diminishing balance method. Now under this method, a fixed percentage of the diminishing value of the asset is written off. First thing that we notice here is that the asset value is diminishing every year because of the depreciation that we are providing in the accounts. For the purpose of accounts, we are showing a diminishing value which is diminishing by a different amount every year. And every year, since we take the fixed percentage of the diminishing value and the diminishing value is changing, therefore the depreciation amount also changes every year. And ultimately, the entire cost of the asset will not reduce to zero by providing the depreciation for the purpose of the accounts. As we can see that the cost minus scrap value is entirely reduced to zero by providing depreciation in case of the straight line method. But in case of the diminishing balance method, the first thing that is important to see is the fixed percentage is used. The second thing that is to be seen here is that the fixed percentage of the diminishing value of the asset is used and written off every year. So therefore, a different value of depreciation is used for every year, and the cost minus scrap value is not completely reduced to zero by providing depreciation during the useful life. Now, repairs and small renewals are charged to revenue. Whenever we make small repairs or small renewals, which do not have a long-term advantage of more than a year, that expenditure would be debited straight away to the profit and loss account in the diminishing balance method. Now, this method is commonly used for plant fixtures, etc. Under this method, the annual charge of depreciation will decrease from year to year, so that in the earlier years of the asset, when the asset is newer, it will suffer more depreciation, and in the later years the depreciation will be lesser, because the value of the asset is diminishing for the purpose of accounting every year. Of course, actually also the value must be decreasing, but that depends upon the market price of that asset. But for the purpose of depreciation, while we provide the depreciation on the basis of an estimate, as we provide the depreciation, we say that the value of our asset is decreasing by the depreciation that we have provided. Now, under this method, it must be remembered that the value of the asset will not completely be extinguished at all, or cost of the asset minus scrap value will not be completely extinguished at all, which ordinarily happens in the case of the straight line method. However, this method is very simple to operate. It may look a little complicated initially when we define it, but it's not at all difficult. This method has an assumption behind it. The assumption behind this method is that the cost of repair will increase as the asset will become older and older, and therefore the depreciation in the earlier years should be higher, because at that time the repair cost is expected to be low, and in the case of later years the depreciation would go up. In the later years the repair cost would go up, and therefore depreciation should be low when the repair cost is expected to be higher. So as the repair cost goes on becoming higher and higher, the depreciation amount goes on becoming lower and lower. So there is a balancing happening there. So what will happen is that equal burden will happen in all the years of the use of the asset, as depreciation will reduce while repair cost will increase. On the other hand, under the straight line method, the depreciation will be constant, while repairs will go on increasing with the life of an asset. And as repairs go on increasing and depreciation remains constant, the charge on account of depreciation and repairs will go on increasing. Now, there is a disadvantage also in the diminishing value or diminishing balance method. The disadvantage of one of the disadvantages of this method is that we may adopt too low a percentage for depreciation, and therefore with the result that over the life of the asset full depreciation may not get provided. And another disadvantage is that if the assets are grouped in such a way that we are not able to identify individual assets over there, the residue of an asset may lie in the asset account even after the asset has been scrapped as far as we are concerned, as because we have already provided the enough depreciation. Not only that, once we have discarded the asset, it has gone away, it is no longer being used in the business, and yet a residue of an asset can lie in the grouped individual assets, because over there the value is not getting fully extinguished at all. So this difficulty could, however, be overcome if we maintain a plant register, and therefore in the plant register we may scrap an asset completely once we have provided the depreciation over the useful life, even if the value is not completely become zero. So the rate of depreciation under this method can be determined by this formula: 1 minus nth root of the residual value upon the cost of the asset into 100. So this formula can be used to calculate the rate of depreciation. This formula is also based on the n being the useful life When we take nth root, which means that we are taking it is 5 years is the cost life of the asset, then we take the fifth root of this value, residual value upon cost of asset. And by this method, a rate can be calculated. Similar to the straight line method, so when we calculate the rate by this method, we have got a certain formula to calculate the rate. So therefore, we do not make a mistake of taking too low a percentage, which was the disadvantage of this method. So therefore, by using this formula, the too low a percentage risk is reduced. Of course, the residual value, which is the value which remains, or the scrap value, which we call, is always an estimate, and that could be a reasonable estimate also. Now, similar to the straight line method, in this method also the period of use in a particular year, that is, for how much time that particular asset was used in the year, that has to be taken into account while computing the depreciation. Because let's say if out of 12 months the asset has been used for 4 months only, then we take the 4 upon 12 percentage of 4 upon 12 of the total depreciation that will be allowing in that year. Now, how the accounting entries are made under both the methods? So, for making accounting entries, there are two alternative approaches for recording the accounting entries. The first alternative approach is that we open a provision for depreciation account, in which we will be accumulating the balance of depreciation and the assets, and assets will be recorded at historical cost. So in this method, what we are doing is that the asset cost will not change in the balance sheet over the years, and we'll be creating a provision for depreciation account, and we'll be crediting the provision for depreciation account every year with the amount of depreciation that we have provided, keeping the historical cost in the balance sheet of the asset fixed. That will not change. So either we reduce the depreciation from the historical cost on the right side or the asset side, or the asset side, and then we go on reducing the value of the cost of the asset every year. Or what we can do is that we add an amount in the provision for depreciation account, or credit the amount in provision for depreciation account by debiting the depreciation account. In this manner, all the depreciation that we are providing, we are accumulating that in the provision for depreciation account rather than reducing it from the asset value. And when we when we debit the depreciation account, finally we transfer that debit balance of the depreciation account to the profit and loss account by debiting the profit and loss account and crediting the depreciation account. By this method, the depreciation account gets closed. And the balance of the depreciation account is transferred to the profit and loss account. The second alternative is that the depreciation would be reduced from the asset value by crediting the asset account every year, and the asset account is carried at the historical cost less depreciation rather than at historical cost itself. So the entries that are supposed to be made here is that we debit the depreciation account and we credit the asset account first by the amount of depreciation. And thereafter, what we do is that we debit the profit and loss account and we credit the depreciation account, and thereby transferring the balance of the depreciation account to the profit and loss account. Ultimately, the depreciation account balance is to be transferred to the profit and loss account in the accounts every year. Now, let us take an illustration. Jan Brothers acquired a machine on 1st July 2015 and they paid a cost of 14 lakh rupees. And in addition, they spent 1 lakh rupees on the installation of that machine. The firm writes off the depreciation at 10% per annum of the original cost every year. So what we mean is the depreciation rate is 10% of the original cost. So if the original cost is, let's say, 100 rupees and 10% is the write-off, then a depreciation of 10% would be provided, calculated on the original cost at 10 rupees. Now the books are closed on 31st December every year. So it is an annual year which is being followed here. So if the annual year is being followed, you can see that the significance of this date, 1st July 2015, because 6 months have already passed. So therefore, since 6 months have passed, he will get a depreciation only for the purpose of, he'll get a depreciation only for those 6 months. Because the machine was acquired after passing of 6 months. So we have to calculate, show the machinery account and the depreciation account here. So therefore, as you can see the machinery account here, we are seeing that machinery was purchased. So we debited the machinery account by 14 lakh rupees on July 1 because the machinery was purchased on July 1, and we credited the bank account because we made a payment from the bank. After that, some installation expenditure was also incurred, so that will also be added to the value of the asset. So therefore, installation expenses of 1 lakh are also being debited to the machinery account, and the bank account is being credited for that. So total 15 lakh is the cost of the asset, and on 15 lakh, on the other side, a depreciation is provided by crediting the asset account and debiting the depreciation account. So you can see here depreciation account has been debited by depreciation account 10% on 15 lakh for 6 months. So here 6 months depreciation is being provided because the machinery was purchased on 1st July, which is after the end of the 6 months. So it was available for use only for 6 months period. So we take 10% and then half it. 10% is, let's say, 1,50,000 rupees. Half of that, that is 6 months, 6 out of 12, there is half of it is 75,000 rupees, and that is the depreciation that has been taken. Now, having provided the depreciation, we are left with a balance of 14,25,000 because this amount is being arrived at by subtracting the credit side amounts from the debit side amounts. Now this balance carried down of 14,25,000 is taken to the next year as balance brought down, and then again depreciation of 10% is going to be provided on 15 lakh because we are using a straight line method here. So we are not reducing the value. We may be reducing the value of the asset, but the depreciation will be provided at the rate of a fixed percentage on the original value or the original cost of the asset. including the labor charge. So here again 10% of 15 lakh, which means 1,50,000, and this is for the entire year is provided, and the balance carried down is 1,75,000, and this balance goes again to the next period. Now, as far as depreciation account is concerned, wherever we are crediting the machinery account, we are debiting depreciation account. So we have to show those debits here in the depreciation account. You can see two debits are there. One is 75,000 account, and one is 1,50,000 account.
Sir,
75,000 is the depreciation that we had provided once, and then we had provided 1,50,000 in the next year. Yes, yes, please ask the question.
sir, during calculation of depreciation for a period of 6 months, are we going to consider the use of 6 months or use of 180 days to calculate the percentage of depreciation to be applied?
Yeah, because here, if we are having the exact date, then we can go by the exact date also, because proportionate depreciation has to be taken. So when proportionate depreciation is required to be taken, then we don't need to go by months. We can just go by the days.
Sir, over in the problem, it is given 1st of July, so definitely it has gone more than 180 days. So we are taking half the depreciation rate.
We are taking half because the machinery was purchased on 1st July, and therefore it was available for use for 180 days. And since the machinery was available for use for 180 days, 180 days comes to 6 months.
Sir, if we calculate, it will be more than 180 days, starting from 1st July till 31st December.
Yeah, maybe you are right in that sense, but that much of difference is not very crucial. And in case you are doing some question like this, and if you take the number of days, you can mention in the question that you have taken the number of days, and that is fine. Because here,
Okay,
in accounting, it is also possible that here in this, although in this example, the machinery has been purchased on 1st July, but machinery will not always be purchased on 1st July. It could have been purchased on, let's say, 9th July. Now, if the machinery was purchased on 9th July, what are we going to do? So unless if we are going by month method, then it won't work in that case.
so sir, in exam actually we are going to take a month method or we are going to go by the day method?
If it is a bookkeeping paper, okay, then
Okay,
it
sir.
is expected that in the question they should specify this, that if the date is specified, you can always assume that you are taking the days method, because it is no month method is prescribed as such.
Okay, okay.
What they are saying is that you have to take the period for which it was available for use. So there is no prescription for using a month method. Here they are writing 6 months in this example, because what they are meaning thereby is that the machinery was used for half of the year, so we are going to allow a depreciation of half of the year. But they could have easily said 182 or by 365 or something like that. They could have used a proportion, and that would not be wrong either. Of course, for any business, if the business wants to be very careful, because ultimately you see the depreciation amount is an estimated amount. It is not something which is 100% accurate or something like that. It is the depreciation is based upon the estimates. It is based upon the estimates of the residual value. It is based upon the estimate of the useful life. So there are so many estimations being made here that no prescription like this could be made that we have to use the month method or the days method. All that is being said is that the proportionate amount of depreciation should be allowed. But we'll have to look at the accounting standards to see that what are the international accounting standards saying about this. We'll do that in the accounting standards part. But as far as the income tax is concerned, they are a very simple formula is given. So here we are not talking about income tax, we are talking about accounting, and we are talking about proportionate value to be taken. So, here we are trying to understand the difference between the two methods. So, essential thing to be understood is that when we are using this, either the straight line method or the diminishing balance method, the proportionate amount has to be taken in both the methods. So, as far as taking the proportionate amount is concerned, there is no difference between the two methods. So, well, here it is written that they are going to take it for half the year, and they have therefore taken half the year, because here also they have estimated a half the year estimate of the availability of use of the particular asset. So I hope that this accounting is clear how it has been done. Now we go to illustration 2. In the illustration 2, we are going to use the reducing balance method. The question is the same, but here reducing balance method would be used. And as you can see, that we are supposed to show the machinery account on the diminishing balance method. So in the machinery account, we are seeing that the machinery was purchased on July 1 for 14 lakh rupees, and this 1 lakh is the installation expenditure that was made. So total cost of the asset comes to 15 lakh. Bank account is being credited in both the cases. Machinery account is being debited in both the cases. Now, as far as providing depreciation is concerned, you can see 10% of the cost. Cost is 15 lakh. So 15 lakh, 10% of 15 lakh is taken first, and then 10% of 15 lakh would be for the entire year. So 6 by 12 percentage is being taken by imagining that the machinery was used for 6 months out of the 12 months, as it was purchased once again on 1st July 2015. So while making the account, if you are writing in months like this, it's all right. Nothing wrong with this also. If you want to be very, very accurate, then you can convert this into days also. I think in our papers that we are getting in the exam, number of days are being used there. Now, balance carried down is based upon the difference between the left side and the right side, between the debit side and the credit side. So that is 14,25,000, because we have reduced 75,000 from 15 lakh and getting a figure of 14,25,000. And this amount of 14,25,000 is the balance carried down, and then we carry it forward to next year, January 1, because accounts are being written from January 1 to 31st December, and this is the balance brought down on the debit side. And then we apply the depreciation for the next year, and this depreciation is being applied at the end of the year. You can see the date is very significant, December 31st. That is at the end of the year, this depreciation is being calculated. But however, this depreciation is being calculated now not on this 15 lakh rupees, but it is being calculated at 10% on this balance brought down, or the reduced balance. That is why we call it a reducing balance method or diminishing balance method. Now here I want to point out that they are not writing that there is any residual value here. Because if there was a residual value, that could have been reduced out here. So no talk about residual value. If there is no talk about residual value, then we need not reduce it. But if a residual value is given here, then that is to be reduced. And depreciation account in the next year is 10%. Depreciation amount is 10%. So 10% of 14,25,000 comes to 1,42,000, and that is the depreciation being provided here in the second year. So you can see that depreciation amount is reducing every year because depreciation is being provided at a fixed percentage on the reducing balance. Okay, now we go to the sum of the years of digits method. There is another method called the sum of the years of digits method, and let us see what this method is all about. It is another variation of the reducing balance method. Now what is being done here is that to calculate how much depreciation would be allowed annually, we multiply the original cost of the asset less the estimated scrap value. So we take the original cost of the asset and reduce the estimated scrap value from it, and once we get that amount, we multiply that by a fraction, and the fraction by which we multiply is a fraction of the number of years of remaining life of the asset upon the total of all the digits of the life of the asset in years. So for example, supposing the estimated life of an asset is 10 years, and so what we'll do is that if the estimated life of the asset is 10 years, we will add the digits from 1 to 10. So we will add the digits from 1 to 10, and we get a figure of 55. So this 55, what we are getting here, 55, is by adding from 10 to 1. We can get this figure of 55 by using this formula also, n into n plus 1 upon 2, which you must have studied in class 5 or 6 in mathematics, that if you have to calculate the total of consecutive numbers, then we use this formula n into n plus 1 upon 2, where n is 10, because 10 here is the number of 10 is the, and we are totaling from 1 to 10, starting from 1 up to certain number. If we have to total, then we see the last number, and if the last number is 10, then 10 into 10 plus 1, which is 10 into 11 upon 2, which is 55. So 55 is the total of all the digits of the life of the asset. So the life of the asset is 10 years. We total all the digits. So 55 will come here in the denominator. And the number of years of the remaining life of the asset, supposing the life at that point is 10 years, we will take 10 upon 5. So the depreciation to be written off in the first year will be 10 upon 55 of the cost minus estimated scrap value. In the first year, that much depreciation will be provided, and for the second year, when we are calculating the depreciation for the second year, then at that time this 55 will remain the same, because 55 is the total of the digits of the entire life of the asset, not the useful life at that point of time. 55 would remain the same every year. The remaining life will reduce by 1 year. So in the first year, it is 10 by 55 of the cost minus estimated scrap value. In the second year, it will be 9 by 55 of the cost minus estimated scrap value. Because cost is the same, estimated scrap value is the same, 55 would also remain the same, just the numerator is reducing every year. So in the third year, it would be 8 by 55 of the cost minus estimated scrap value, and so on and on. So in this way, in this method also, we are getting a reduced value of depreciation. So it is a variation of the reducing balance method, because here also the balance is reducing, but in the reducing balance method, the balance is reducing by taking a fixed percentage of the cost minus estimated scrap value. But here in this case, instead of taking a fixed percentage of the cost minus estimated scrap value, we don't take a fixed percentage, we take a varying percentage itself. So in the first year we take 10 by 55, second year we take 9 by 55, third year we take 8 by 55, like that it goes on reducing every year. Now this method is not much in fashion, and though its advantages are similar to those of the reducing balance method. So because here also the assumption is that every year as the asset goes on becoming older and older, its repair cost will go on increasing, and therefore we have to provide uh, to equalize the burden of every year. In the initial years, we'll provide more depreciation when the repair cost is less, and in the later years, as we move forward, we'll go on reducing the depreciation as the repair cost keeps on shooting up. Now, illustration 3 is based upon the sum of the years digits method. So just for academic purpose, although we are not using it as part of our syllabus for the departmental exams, but for academic purpose, we'll just go through this illustration also. A machinery was purchased for 10 lakh rupees, and the estimated useful life and scrap value of the machinery were 10 years, and scrap value was 1,20,000 rupees. Estimated useful life was 10 years. Estimated scrap value was 1,20,000 rupees, and machinery was put to use on 1/1/2010. And when we say the machinery was put to use on 1/1/2010, and if we assume that the accounts are being made on an annual basis, we can say that this machinery is being used for the entire year. Of course, if the machinery was not used for the entire year, then the proportionate amount has to be taken. So here again, what is happening is that we have to apply, we have to start with we have to show for 2015. So we have to, the machinery was purchased on 1/1/2010 and it was put to use also on 1/1/2010. But however, in this question, we have to show the machinery account in their books for 2015, which is after 5 years. So therefore, what we do is that we calculate the value as on January 1 initially. So the value of the machine, it is diminishing value based on the depreciation that has been provided. So we started with 10 lakh rupees, but after diminishing the value, gradually the value becomes 3,60,000 rupees. Now how this 3,60,000 rupees is being calculated, you can just see out here in the example. So while calculating this example, we know that first thing that we have to do is that we have to take the cost of the machine, which is 10 lakh. Then we reduce the scrap value, which is 1,20,000. And having done that, we get an amount of 7 lakh, 8,80,000 rupees. And this 8,80,000 rupees we are going to multiply with we are putting 55 here, and the total sum of the digits for 2010 to 2014. For 2004, if you have to calculate the depreciation only for 2010, then we say 10 upon 55, and for next year it will be 9 upon 55. For next year it will be 8 upon 55. So when we are adding all those depreciations, this 8,80,000 will become common. So we can just take this as common, and we can add up all the depreciations for every year by saying 10 plus 9 plus 8 plus 7 plus 6. If we don't want to do that, we can just go on doing 10 upon 55 of 8,80,000 plus 9 upon 55 of 8,80,000 plus 8 upon 55 of 8,80,000, like that. So it will come to the same thing. So finally we get the total depreciation for those 5 years as 6,40,000 rupees, and we reduce this total depreciation that we have allowed from the cost minus scrap value, that is 8,80,000 minus from the cost. And so from initial cost was 10 lakh, so from 10 lakh we are reducing this value of 6,40,000, because this is the amount of reduction that has happened in the written down value of the asset, because the total reduction of 6,40,000 has happened due to the depreciation. So we had purchased the asset for 10 lakh rupees, and we have allowed depreciation of 6,40,000 rupees. So from this 10 lakh, you go on reducing the depreciation every year, and when we come to the end of 5 years, we have done a total reduction of 6,40,000 rupees. So therefore, we are left with 3,60,000 rupees. So that is how this 3,60,000 rupees is the balance as on January 1, after having provided the depreciation for 2010, 11, 12, 13 and 14, 5 years. And now we are providing the depreciation for the year 15. So for 15, we have started with a reduced balance of 3,60,000 rupees, and then obviously how much depreciation will be provided on this 3,60,000 rupees. It will be based upon the same sum of the years formula, and this will be 5 upon 55, 5 upon 55 of 8,80,000 rupees, and that figure is coming to 80,000 rupees. So we have provided a depreciation of 80,000 rupees, and then we reduce this 80,000 from 360 to get the carried down balance here. The debit side is more than the credit side, so it's a debit balance being written on the credit side. And finally, this debit balance is brought down on 1st of January of the next year. So this brought down entry is required to be shown. This is very important. And the depreciation account, if we have to see for this year, only for 1 year, the depreciation of 80,000 is being provided, and that goes into the profit and loss account, because to close the depreciation account, we are transferring the balance to the profit and loss account by, crediting the depreciation account and debiting the profit and loss account. And there are a few more methods also which are of academic purpose for us. We'll just go through them since we are studying the topic of depreciation. Now there is another method called the annuity method. Now this is a method of depreciation which takes into account the interest on the capital outlay. What happens is that we have made a capital expenditure on the purchase of the asset. If we were not to make the capital expenditure on the capital asset, then if we had put that amount in the bank account, we would be earning some interest on it. As we have made the expenditure for the purchase of asset, we are losing that interest by not putting that money into the bank account. So this method of depreciation will take into account the element of the interest on the capital outlay, and it will seek to write off the value of the asset as well as the value of the interest which is over the life of the asset. So here, not just the value of the asset will be written off by depreciation, even the value of the interest which was lost over the life of the asset or even the value of the interest which was lost, that will also be written off by way of depreciation over the life of the asset. Now, this method assumes that the amount which is laid out or the amount which is spent on acquiring any asset, if that amount was invested elsewhere, or let's say if it was put in a bank, or if it was invested elsewhere, you can say, it would have earned some interest. Now, we must reckon that interest as part of the cost of asset because we have lost that interest. So therefore, it adds to our cost. And on that basis, the amount of depreciation which we'll provide annually in the accounts will be ascertaining it from the complex annuity tables, because here formula is very complex. We don't need to apply that formula every now and then because we won't be able to do that unless we are a complex mathematics student. So therefore, for ease of use, annuity tables have been provided. They have been prepared and provided to find out how much depreciation would have to be provided every year to be able to write off the interest on capital outlay as well as the capital sum that has been spent to purchase the asset at a rate that so that the whole of the capital sum and interest which is accruing thereon would be written off over the life of the asset. In this case, what is being written off is not just the capital sum, but the interest also. Interest lost or interest which could have accrued to us, but we are not getting it now. So all that will be written off by depreciation, and the amount of depreciation would be taken from the annuity tables. Though the amount which is to be written off annually in this case is a constant amount, just like the straight line method. In the straight line method also the annual amount of depreciation is a constant amount. Here also it is a constant amount. The interest in the earlier years, though interest is more in the earlier years, so only a small amount of the capital sum is written off, but more of the interest is written off in the earlier years. Because what happens is that the interest loss amount is more in the earlier years and it is lesser in the later years. So therefore, what we are doing here is that though we are writing off the constant amount every year by using depreciation at a constant amount which is taken from the annuity tables, but what we are actually doing here is that we are writing off more of interest in the initial years and less of the capital amount. And in the later years, it reverses with the passage of time, and in the later years, we are writing off lesser of interest and more of the capital sum. So this kind of method will be eminently suitable for writing off the amounts which are paid for long leases, and wherein long leases which involve a considerable capital outlay. So it is not practicable to adopt this method for writing off the depreciation of plant and machinery that we are buying straight away. But where we are taking it on long leases, it is more relevant. Because in case of plant and machinery, there is a frequent change in the value of the assets, which would necessitate the recalculation of the amount of depreciation to be written off annually. So because it depends upon the interest and the value and those things. So therefore, it is not practicable for plant and machinery depreciation calculations and should not be used there. And it is mostly used for long leases only. Now, the journal entry is that wherever interest on asset account, for charging interest on the asset account, what we do is that we debit the asset account and we credit the interest account. And then what we do is that we debit the depreciation account by the depreciation amount and we credit the asset account or we can also credit the provision for depreciation account. If we assume that we are crediting the asset account, we are providing here the depreciation by debiting depreciation account and crediting the asset account. Then we transfer this depreciation to the profit and loss account by closing the depreciation account by crediting it and then transferring it to the profit and loss account. And finally, we transfer the interest also to the profit and loss account. By this, we are closing the interest account by debiting the interest account and transferring the interest also to the profit and loss account. So here we are accounting for the interest loss that we are incurring by initially debiting the asset account and calculating the interest account. So we are adding basically the amount of interest to the cost of the asset by making this first entry. And finally, the interest amount that we have included in our accounts that we have lost by not investing to gain interest, we account for that interest loss by transferring that interest to the profit and loss account. So this is an expenditure that we are incurring here, or we are including it as interest loss or an expenditure of the interest. So we go on to the illustration 4, and this illustration 4 is basically dependent upon this annuity method of calculation of depreciation. And as we have seen that in the cases of long leases, this method of calculation of depreciation by annuity method is relevant. Important point here is this in this annuity method is that the amount which will be calculated for every year will be the same. It will not differ. The depreciation amount will not differ. It is taken from the annuity tables. Now let's take an illustration to understand this method for academic purposes. And in the example, it is mentioned that a lease is purchased on 1st of April 2012, and this lease is for 4 years, and this lease is purchased for a cost of 2 lakh rupees. Now, we are proposing to depreciate the lease by the annuity method by charging 5% interest here. We have decided that we'll calculate 5% interest loss over here. So we refer the annuity table, and when we refer the annuity table shows that if we have to depreciate 1 rupee by annuity method over 4 years, because here also the lease is for 4 years, so we have to check out in the annuity table that if we have to depreciate 1 rupee over 4 years by charging 5% interest rate, then we must write off a sum of 0.282012 every year. But we have to depreciate 2 lakh rupees, so we multiply this 0.282012 by 2 lakh, and we get a figure of 56,402 rupees and 40 paise. So this will be our depreciation amount for every year. So we are supposed to show the lease account for 4 years and also the relevant entries in the profit and loss account. So we are seeing this lease account here. Initially, the lease is purchased for 2 lakh rupees by paying from the bank account, and lease account is thereby debited. Then we add the interest of 5 lakh rupees, or interest on 5% on 2 lakh rupees, add 10,000 rupees to it, and the total cost of the asset plus interest then comes to 2,10,000 rupees. Irrespective of this cost, since we have already referred to the table, we know the depreciation that we have to provide here is 56,402.40 as we have calculated above. After providing this depreciation, we get a balance by reducing this right side from the left side, and we get 153,597.60. This is then brought down to the initial part, the date of the next year, which is April 1, and On this, again, the interest of 5% is calculated. So that is 7679.88, and total of the two is 161277. Now depreciation would again be the same amount as in the earlier year, 56402.40, and the balance which is carried on will be a difference of both sides, that is 104875.08. This amount is again carried forward, was brought down to the next year. Again, interest is calculated on this amount as 5% on 1,04,875.08, which comes to 5243.75, and then we include a depreciation of the same amount that we have used earlier years, and in earlier year, and thereby we get a balance carried down 53716. So you are seeing that every year the amount of the balance that is being carried forward is reducing. So it is a reducing balance method in a way, and the depreciation amount, however, is the same, being allowed every year. So here we are getting exactly 56402.25, and finally we apply this depreciation of every year, and this gets extinguished, and by this method our account is totally closed as far as balance is concerned, because that asset value is totally extinguished from the account, and whatever depreciation we are giving every year, we are transferring it, whatever depreciation and whatever interest is being credited is being transferred to the profit and loss account. And as you can see, the profit and loss account here, and the interest amount for every year is being mentioned here, 10,000 for the first year, and then 7679.88 the next year. So this interest amount is being added to the value of the asset every year. So therefore it is being credited to the profit and loss account, and the depreciation is being reduced every year. So that is being debited to the profit and loss account, and whereas the profit and loss account is being credited with the interest amount and debited with the depreciation amount every year. So those are the entries in the profit and loss account. And then we come to a sinking fund method also. So there is a sinking method also, which I think we'll be covering. We'll cover that in the evening session, because we have substantial things to cover in this topic going forward. And for though these methods that we are covering, like annuity method, the sinking fund method, they are basically for academic purposes, but if we cover them, then we get a broad and a good overview of the depreciation accounting methods that are being used for various purposes, and therefore it is worthwhile to understand them also. So we'll continue with this chapter in the evening session at please join us at 8:45 p.m. in the evening for that session. Thank you very much for having attended this session.